Okay, so we're just going to go back. We're all settled here. All right, good. We're going to do this one, this part quickly. Revolver. Yep. Good. Yeah, keep pointing that out to me because I'm going to keep forgetting. What's that?
Yeah, Joe, why don't you stop broadcasting and rebroadcast it? Yeah.
So I feel like I lost my chat too.
I'll get that up for you.
All right. Oh, you're right. Their name is Jerry, by the way.
Jerry?
Yeah.
So I was thinking somebody named Blerta, but
Oh no.
because I know she was from Albania, but I know Sal because
Okay.
through school and stuff.
Right. Next, I'm thinking of I was thinking of the maiden name of my brother's wife,
Right.
which is that's it for nephew. That's why.
Good. Got it. And I'll get the chat. The chat's right there.
Is there any way I can just, if I split screen this, they'll still see this. They'll still see the Excel, right?
Mhm.
I just want to kind of keep the chat sideways there, off to the side, so I can make sure I'm not missing anything. Okay, so it's always there. It just needs to be. Got it. Okay. A lot of windows open. Excellent. Okay, so they're still seeing. See, it seems like, are they seeing this? Okay, so they're seeing this. Okay, excellent. So risk and return, right? If you were to rank these, let's rank these here. 1 to 5. And let's say 1 equals least risky. 5 equals most risk, or highest return. Let's look at it that way. Okay. So we kind of talked about this a bit, but let's just think about this a little bit more. So which of these would be number 5? Which would you want the highest return for? If a company had all of these securities in a capital structure, which would be the security that gets the highest return? Equity. Okay. And why is that? Why is it more risky?
Because when you're looking at all the other ones, the first one, secondly, and investment, they all before incorporate. The company was the owner, they will get paid way before equity.
Exactly. Just for everyone else that couldn't hear that on Zoom, what she said was that everyone else, if there's a liquidation, is going to get first claims on the company's assets. So you want the highest return, right? So which would be the least risky of all these? Which will get the lowest return? No, not the first lien. The revolver. And why is that? Well, why would be the least risky? Because what is the revolver backed by?
Their working capital, like the assets.
Exactly. So if the working capital is backing the revolver, what does that mean? If I liquidate, what do you get?
Yeah.
Exactly. Now, a revolver is typically based on accounts receivable is number 1. That's typically what it is. And usually what they do is they give you 80 to 85% on your receivables. Why 80, 85%? Why not all of it? Why would a revolving lender provide you 85% or 80% on receivables and not 100% of your receivables? Yeah, go ahead.
There's some loss of value through time.
Some loss of value through time. You're getting there, and why? Why is there a loss of value through time?
It's not there, it's appreciated.
Well, so what is an account receivable? In its simplest term, somebody owes you money, right? So a loss of value over time, what does that mean? If I have, okay, this is a good risk and return game. What would be, what?
So iPhones, right? So Apple, you have iPhone 10, and all of a sudden there's iPhone 11. The iPhone 10 that you have are worth less. So
That would be the inventory.
right, you have iPhone X on order, and they come out with iPhone 11, and now the ones on order are worth less because they have a new model.
Okay. I'm thinking about it a little bit differently. Let's think about it this way. I gave you 2 buckets of receivables. I gave you $1 million of receivables that are 20 days old. So we're out 20 days, right? They owe me money for 20 days. And I gave you a bucket of receivables, $1 million worth of receivables that are 120 days old. All right. One bucket is 120 days old. One bucket is 20 days old. Which do you think are more valuable? 20-day-old receivable versus 120-day-old receivable. Which one would you be more willing to buy?
20 days old.
20 days old. Why?
I don't know, that goes back to time value money.
Well, forget time value money. Let's just be as basic as possible. Somebody owes me money for 6 months versus somebody owes me money for 10 days. Why is it more valuable for 10-day-old receivable?
You're more likely to get
Right. Robert, I'll tell you, if we were playing teams here, the Zoom team would be winning this game. The 20 days, less risk of not paying it back. Thank you, Robert. Exactly. 20 days is more valuable to me because it's only 20 days old. If you haven't paid me for 6 months, you're likely not paying me, right? Does that make sense to everybody? If you haven't paid for 2 years, you think you're going to get your money back? More basic. Have you ever lent money to a friend and then you just never talk to them again? The most likely you're never going to get that money back, right? So now, if you wanted to sell that, let's say Joe owed me money, and I went to you, Cal, and I said, all right, Joe's owed me money. First question you'd be like, well, how much does he owe you? Oh, he owes me $100. Okay, right, $100. Okay, he owes me $100. Great. I want that money today. Okay, you would want a discount on that, right? What if I told you I lent him the $100 5 days ago? You'd feel a little bit more comfortable, right? What if I told you I lent you $100 6 years ago and he still hasn't paid me? If you say forget about it. So this is the whole idea. Lenders on a revolving credit line are only going to give you 80 to 85% because there's going to be some loss, right? There's going to be some uncollectible account, some amount of money that you're never going to be able to get. So they don't want to give you the full amount because then when somebody doesn't pay you, those numbers are declining, right? So if it's 100 million, they're going to say, okay, let's give them 80 so we get a buffer. But what is the point of that? This is, again, risk, right? This is them controlling risk, managing risk. Does this make sense to everybody? Everybody gets this concept? Managing risk. And that's why I keep going back to risk and return, risk and return. It's all baked into this. So 1, the revolver. 2, a first lien. What is a first lien piece of debt? All a first lien piece of debt is a term loan. So what does a term loan mean? What does the word term mean? A time period. So this is 5 years, 10 years, 7 years. There's a term on the loan, term loan. And generally, this term loan is going to be backed by inventory. It could be backed by property, plant, and equipment. Now, collateral. It's got to be collateralized against something, an asset. Now, not all not all term loans are collateralized because let's say, again, we can use a technology thing. Let's say it's a technology company that does generate cash flow that can repay me my debt, but they don't really have many assets. So this is a cash flow loan, right? So it's not going to really be collateralized against anything. Terms, right? These are, and I got to get better at this for myself, for you guys. Terms is like, I want you to highlight things. What's a cash flow loan? What does that mean, right? You're just lending on cash flow. If it's an asset-backed loan, what does that mean? We're lending against an asset. These are things I want you to kind of be able to pick up. An asset-backed loan, we're lending against assets. A cash flow loan, we're just lending for the cash flow of the business. There's no asset. Make sense? Okay. So first lien term loans are going to carry higher interest rates than revolvers. There's multiple reasons why. We're going to get into it later, but there's things called leverage. There's things about how much debt that a company can carry. And there's also just the basis of collateral. Liquid collateral versus more illiquid collateral. Let's look at these two things. Accounts receivable is simply money somebody owes me, right? What is property, plant, and equipment? A machine, a building, this building, right? William Patterson gets to carry this, right? On its balance sheet as an asset. This address is an asset. They own it, I assume. So they own the building. If you needed to get cash quickly, right, what would you rather have? $10 million of receivables or $10 million of a building? The receivables, right, because you can, that's a conversion quicker to cash. How are you going to go collect the money? Pick up the phone, hey, I need the money, right? And they're going to pay you because they want to keep doing business with you, right? A building, what do you got to do for a building? Right, and what is that process like? Long, right? Longer term, it's more illiquid. You got to have people who want to buy. Who wants to buy a building in Wayne here? That's, this isn't a single family house. This is just take a longer process, finding the right buyer, matching the right buyer and to the seller. So first lien term loans and just going down. 3, that's all that this was. It was simple, it wasn't a trick question, but revolvers, second lien are usually going to have no collateral. So this is a good example. Collateralized loan, first lien. No collateral, second lien. What would have a higher interest rate? Which would be riskier? Robert beats you in. Robert, good call. Second lien, because it doesn't have the collateral that the first lien has, right? Or if the second lien has collateral on the same assets as the first lien, they're second position. So what does that mean? That means that if we go bankrupt, we both have collateral. You don't get your collateral until I get mine first. You don't get your money back until I get mine first. So if I'm first in line versus you, right? What does that mean? That you're carrying more risk than me, right? So it wouldn't make sense if we shared collateral. Let's say we said, William Patterson, we both collateralize this building. I'm a first lien position, you're a second lien position. This building is worth $10 million, okay? Let's just say. Your loan is collateralized, 10 million. My loan is collateralized, 5 million, let's just say. So we know I'm already underwater. Unless they sold this for more than 10, I can't get my return back in the bankruptcy. Does that make sense? Okay, great. All right. Let's go back now. New share. Here. Okay. Just keep losing this chat function. It's driving me crazy. Okay. Is there a reason why, though, that this...
Maybe the split screen PowerPoint.
Yeah, but I want this open for you all to see. Okay, perfect. Excellent. All right. Discounted cash flow analysis. We already talked about this, so we're gonna come back. Cost of capital. We've touched on these things. We're gonna get into the nitty-gritty probably later today or tomorrow on this, I would say. Well, let's think about the cost of capital. And I lost this chat again. All right. Great. You can't touch anything. What is the cost of capital? What does this mean? We already touched on this. In its most basic form, what are we talking about? What have I been consistently pushing here today? Risk, right? Cost of equity and a cost of debt. A cost of debt, we can kind of see that. It's a little bit more tangible. Because why do we know that the cost of debt is a lot more tangible? Because what is a loan? It's a contract between two parties. It's a legal agreement that you and I have made with lawyers, and we've had a discussion on interest, on rate. How much do I owe you? I owe you 7%. I owe you 8%. I owe you 9%. We're not going to talk about fair value because these are two separate things. Fair value, book value, market value. An interest rate on a loan, just because I gave you a loan for 7%, is that loan worth 7% return today? What would cause, general terms, if I gave you a loan at 7% yesterday, what would happen in 6 months that would no longer make that loan, make the 7% return adequate any longer? What would happen? Let's say, what would make that loan become that, maybe that loan you should be getting 10% instead of 7%. What would happen? Interest rates rise with a question mark. So he's kind of like, interest rates rise, I think? I'm not sure. Well, what's the question mark, Robert? What are you thinking about? As you're along the right track in one part of it. That's not the whole answer, but it's part of it. Interest rates rising. Interest rates are a base rate, right? Government rates are base rates. So we think about things like LIBOR. We think about things like U.S. Treasury. We think about these things. We call them risk-free rates. Not sure, but higher risk premium makes it less attractive. Exactly. That's a great point. I mean, so on point. The thing is that if your base rate was 1% yesterday, right, and I'm lending you at 7%, right, the difference between these two things is called a spread. 6% is a spread. 1% base, 7% is the total interest you're paying me. So my spread above a base rate is 6. Let's say currently the 10-year treasury is about 170. Let's call it 165, 170, 1.65%, 1.7%. So anything above that in a loan, on a 10-year loan, because you got to match terms, you got to match maturities. 10 years when you have a 10-year base rate, that's a spread. If interest rates rise, right? So base rates go up. Let's say we go from 165 today to 5%, right? Let's say we went to 5%. I'm lent you money at 7. My spread just went from 6 to 2, right? If I wanted to retrade that now, I wanted to sell that back out to the market, a market participant to buy that, it would not be very attractive to them. Why? Because you're only getting 2% spread over something I can invest in risk-free. An operating business is risky, right? A government bond is risk-free. So you're taking on risk, right? By borrowing or taking in interest at 7 when only a 2% spread, when you were doing it day one at a 6% spread.
So would that be for inflation?
What's that?
Would that be for inflation?
A form of inflation?
Yeah.
So government bonds are going to be based on inflationary pressures as well as real GDP growth, right? The growth of an economy, how an economy is doing, as well as inflation. So it's kind of baked into that as well. So that's part of it. But what's another thing? Let's say interest rates stay flat. Government stays flat. Nothing moves. What would be another reason why your operating business? Look at it from an operating business perspective. You're an investor. I lent you money at 7%. Why would I need 10 now?
You're not meeting the target that you guys agreed upon, with the discipline as you expected.
So exactly. Performance is weakened. Performance has gotten worse. it's gotten riskier. Does that make sense? Okay, so this is when we think about fair value of a loan, fair value of a bond, and the book value, I guess you would call it, in essence, what our contractual obligation is, right? Equity is, and I wrote here, think about this as a spread above the most riskless return as an investor you can get. This is something on market rate and CAPMs. We're going to talk about that later. I don't really want to get into that right now. But the cost of equity would kind of be implied. It's implied in a couple ways. In the private markets, private equity funds try to get 20 to 25% annual return on their equity. So when we do valuation from a private market perspective, it's more of a plug. Like, okay, we know private equity generally tries to get 20, 25%. That's what they try to get. So that's what they're implying that their rate of return is on their cost on their equity. Debt, we know, is contractual. So we can kind of see that as well. We can do a fair market value, but that's not typically what people are going to do. Okay. Terms a little bit more complicated. Sorry. How about I just do that? Is that good? It's okay? Okay. It's okay. No, good. Okay. So I want you to stop me. Anything you're not getting, it's a long day. We'll all start to zone out. I might be talking, but actually zoning out. So, all right. We're going to go back here. Like I said, we're hopping around a bit. The purpose of trading comps is to determine what's the appropriate value of a company based on the market value of operating similar companies. So we kind of talked about this. Yeah, okay. It's the same thing twice, so that's just a typo. Okay. We talked about this as well. This is just talking about houses and companies. It's a lot harder to find comparable companies than there's homes. Homes, we know there's bathrooms, there's bedrooms, there's 2x4s, there's sheetrock, there's tile, there's wood. We can kind of get a good sense of it. Location matters. Obviously, certain homes in certain towns are going to be worth more than certain homes in other towns. So there's, it's a little bit difficult, but generally, if you're in the same neighborhood for the same town, you can kind of get an idea. We need to account the difference too between an equity value. We think about multiples and the enterprise value. So we're gonna just kind of quickly get on that topic, but okay. Do we know? It always confuses people, and I think I know why. But why is the difference between enterprise value and equity value? Enterprise value and equity value.
So enterprise value, taking all the forms of capital of the business. If you're going to buy them, you're going to buy market cap with debt. You're going to use cash there to pay that down. Equity value is like the value available to the shareholders.
To the common shareholders. Yes. And what was the first part? I was moving this. EV accounts for debt. That's correct. But what does it mean to say the total enterprise value? It equals the debt plus the
Market cap.
or the equity.
Equity value.
Exactly. It's all holders in the company. You have to think of debt holders as owners. Why are debt holders owners?
They actually have a stake in it.
Exactly. What is a mortgage company? Does a mortgage company own your home? Yes. If somebody asked you what the value of your home is, what would you tell them? How much equity you have or the total value of your business? All right, total value of your home. Right, which means the debt and the equity. If you bought a $500,000 house and you put $100,000 cash down, you borrowed $400,000, and somebody said, "Hey, Peter, how much is your house worth?" You wouldn't say, "Oh, $100,000," right? That's just his equity in the home. The total value is $500,000. This is it. Never forget that. Always remember that. Don't get tripped up on this in an interview, ever in your life. If you get tripped up on this in an interview, you're not going to get the job. Just telling you that right now. Did this happen to you? Okay. I didn't even know that. I wasn't even calling you out. This is really important. You need to know what enterprise value is. And all it is, somebody says enterprise value, just think home. And just be like, oh man, that guy was there and he told me that if somebody asked me how much my home is worth, it's the debt and the equity. Done. That's all you got to say. So freaking easy. Debt and the equity. That's it. It's the debt and the equity in the business. It's all holders.
You
Yeah.
can really kind of tie that to housing. They don't, person running the business doesn't own the business, the debt holders own the business. Same thing as like the mortgage of the house or something like saying for the car.
Yeah, and then as they pay down the debt, as you pay down your mortgage, your equity pot
Right.
grows.
Full owner if you pay off the debt. whatever.
Exactly. Exactly. Does everybody get this conceptually? Concepts. You get it? Don't lie to me. All right, good. Everybody gets it. Good. Super important. Very, very important because the world is run, the private market world, the entire world in finance, banking, things like this is enterprise value. Somebody's going to say to you, what's the company worth? Do a discounted cash flow analysis. They're not going to want to know the equity value because if you're selling a business, they can't just buy the equity. They got to buy the debt and the equity, right? Because they come along with it. They're holders. They have liens on the business. So that is that. Equity is equity. It's just what we said now. Now let's do the other way around. Same thing with the home example. If somebody said, what's your equity in your home? What would you say? Again, $500,000 example, 400,000 of debt, 100,000 of equity. What would somebody say? What's your equity worth? 100,000, and that's all it would be, because somebody else owns 80% of it, right? So now, if you took a company and a percentage, and let's say you said, I own 10% of the equity, right, of $100,000, you would own what? 10,000, right? If I told you that the home is worth 500,000, you wouldn't say you own 10% of it technically, because if you sold the home, you don't have 50,000 of ownership of that home, right? Why don't you have 50,000 of ownership? Because you have to repay the debt. Exactly. So now let's think about this again. You own 10% of the equity in a house, all right? House is worth $500,000. There's $400,000 to Wells Fargo. You own 10% of the 100,000, so you own $10,000. Okay? We sell that house tomorrow for the 500. You get what? 10,000. But we sold the house for 500,000. Where's 400,000 go? To Wells Fargo. And where's the other 90,000 going? To other equity holders, right? Do we get this? Everybody gets this. No one's ever going to mess this up in the interview.
Hopefully not.
Super basic, important. You have to know it. You can never mess this up. Don't get caught up in math. Don't get caught up in net debt and preferred equity and don't worry about it. Just somebody says, what's the enterprise value? Say it's the debt and equity in the business. It's the total value of the business. Bring up the damn home example. If my home's worth 500,000, I own 400,000 to Wells Fargo, and I got 100,000 equity. The total value of it is 500,000. It's the debt and equity holders, all the holders of the business. Make sense? Okay, I'm very passionate about this because I don't want you to mess that up because it would be very upsetting. Now, if you were comparing enterprise value, again, we talked about this, is debt, right? The debt holders and the equity holders are in the enterprise value. Think of it as people. They're in the debt holders and the equity, okay? So if you were to compare a multiple, your numerator and your denominator got to be on the same basis. Does this make sense, everybody? Okay. Do we know, let's just go from an easier point of view. When you think about a income statement, we think about profit and loss. At the top, we have revenue, right? This revenue, is that revenue, forget any costs in the business. Let's say we had zero costs, no cost in our business, the best business in the world. Every dollar we make is 100% profit. Does that get distributed to debt holders? Does that get distributed to equity holders? Would that profit get distributed to both? To none? What do you think? All the profit before we pay any, forget it, we have no expenses. Everything goes to the bottom line. Where does that money get distributed to? We have debt, we have equity. What's that? To, but who would, let's say we have debt, we got to pay our interest. All right? Both, exactly. So this money goes to both. So can we compare, because debt is interest bearing, right? And remember, enterprise value is interest bearing debt or even non-interest bearing debt plus our equity. We're going to compare that to revenue, right? Does that make sense, everybody? Because in an income statement, this is at the top. So this is going to be distributed to everybody. So this is numerator and denominator, they're the same still, right? Let's look at it that if we went down to net income, what does net income come after? What have we done with our revenue to get to net income? And what else have we paid if we had debt? Interest expense. So now those cash flows, that earnings, have we already distributed it to debt holders? Well, we did if it's net income, right? It's already taken out. Okay. Let's look at it this way. Let's stop share. Let's go back to the old Excel here. Super, super, super important. We don't want to lose this. Sometimes visually it's better. I Zoom people see me, or am I not sharing with them? Okay. Simple income statement. I want you to tell me, now there's different lines of profit here, okay? Or different lines of income, or whatever you want to call it, right here. Okay. I want you guys to think about it. Take 2 minutes. Which one of these would be comparable? Which one of these would you take an enterprise value to that earnings to get a multiple? And which one of these would you use just the market cap or the equity value? Now remember, a couple things we want to think about here. Debt, equity. Where's the debt holders? And what do they have claims on of our earnings here? Okay. So let's think about all those earnings. Revenue is money coming in. Gross profit, money coming in. Operating income is money coming in. Net income is money coming in. Where are we comparing enterprise value to on a multiple basis? So we're thinking about enterprise value. And where would it be on equity? Just take 5 minutes. Think about it first. Just think. You know, I guess it's, I was going to say it's not a test. I guess it's a test. I think control plus. It's funny, I'm the worst at shortcuts today. You know how long somebody asked me how to group? Shortcut for grouping? I still don't know it in my head. I've told people 100 times. Because it's just to do a lot of grouping, so. So Have we thought about this here a bit? Let me see if anybody on Zoom has chimed in. I think I may have lost my Zoom people. I don't know. Oh, we got a chat. I'm here. Look at Angela. Yeah, paying attention. Love it. Thank you, Angela. Angela, how's this going for you so far? Is this you feel good? Am I going too fast? Okay. If there's anything, just stop. Good. Throw a question in there. Super important. I don't want anybody really left behind. All of this stuff is not meant to be understood entirely today or tomorrow. You need to work in the field and understand it, and this other stuff is all important in business in general. You don't need to be a finance major. You know, if you want to be a business major, you're gonna need to know these things. You know, you got to understand how businesses generate profit, and if you work for a large corporation, you know, I think it's just going to be important. Okay, so let's start at the top. Enterprise value, or actually, you tell me, which of these would you compare if you want to do a multiple, right? An enterprise value to what earnings? Which ones would you pick here? Okay, revenue, correct. Next.
Are we still talking enterprise value?
Yeah, enterprise value. I just want to know enterprise. So there's more than one for enterprise value here. That is a multiple. That would be the enterprise value numerator. Which one of these are denominators?
Would be sales, gross profit, and operating.
Gross profit, and what did you say, Joe?
Operating.
Operating income. And why is that? So Joe said for people in Zoom and everywhere else, Joe said you would compare enterprise value to revenue, gross profit, and operating income. Why? Come on, you know why you said it. Couldn't have just guessed 3. Maybe once to get lucky, not 3 times. Because of the, but what is the, all of these are profit or income prior to what?
Taxes.
Before taxes. Interest expense. What's that? What's that?
Gross profit and operating income is basically assets, whereas equity values is definitely expense and revenue. Versus numerator and denominator, right?
It's pre-debt. Enterprise value is pre-debt. Because remember, you're using earnings to pay out. Remember the investors we talked about, or the holders of your business, or however you want to look at it. So operating income is before interest, right? So the interest holders have claim on this operating income, right? Because you're going to use this operating income to pay the interest. Does that make sense? This gross profit is used to pay interest. The revenue is all breaking down to pay interest. Does that make sense to everybody? It does? You sure?
Yeah.
I'm not letting you walk into a JP Morgan investment banking summer job and not know this. I'm telling you right now. I will be knocking at your door and just saying.
Those 3, those are profit margins. What is profit metrics?
Yeah, revenue, calling revenue profit is kind of funny, but yeah, it's conceptually it is income that's generated one way or another that's going to be used to pay down interest.
Or would it just be revenue, gross profit, operating?
Yeah, but people do EV to revenue multiples. Yeah, there are enterprise value to revenue multiples, and generally as a default, if there's no profit, so let's just say, so this is not. I've really never seen this, right? I never seen someone really say, "Oh, what's the enterprise value to gross profits?" It's rare. I guess I've seen it. People come up with a lot of funky ways to do valuation, but it's not normal, I would say. But this is going to be it. Now, instead of operating income, the better term is EBITDA. Super, super important term. And what does EBITDA mean? Earnings before interest, taxes, depreciation, and Yes, Joe.
So would D&A be above the line if operating income portrays as the line?
Yes. So, good point. If you call it operating income, depreciation has been already taken out of there, and amortization has been taken out of there. Typically, EBITDA. So I should say, it's not a slash. It would be more of a okay. That was a good call by Joe. Okay, so that'll confuse you. And I'm not trying to confuse. We'll just leave it down here for now. Operating income, depreciation is taken out of operating income already. What is depreciation? This is my favorite. I still don't think many people get it. I still question whether I understand. What is depreciation? Come on.
I mean,
Yeah, I want you. Just like I'm not failing an interview, man. I got this.
Write down like the useful life for an asset, the expenses over time for the period, for the useful life of the period.
Right.
For the asset.
Depreciate. Right. Okay.
This is better. I guess the value is going down over time.
Right. I like how Robert put it. Depreciation is spreading the cost over time. That's it. This is, you would think about it as depreciation is a non-cash cost that allows you to reduce your taxable profit, okay? Because you're spending money on something, an asset, that is going to be generating profit over time, but it has to be then replaced at some point, right? So when you depreciate something, as Robert beautifully stated it, he's spreading the cost over time. I really like that. I'm going to use that. So thank you, Robert. Spreading the cost over time. Now, is that a real cost or isn't it a real cost? This is a debate, I would say. This is a financial debate. But so there's no right answer here. But do you think that depreciation is a real cost or is it not a real cost?
It depends on the asset.
What'd you say, Kellen?
Depends on the asset.
She said it depends on the asset. So talk to me more about that. What does that mean?
So say if I get a
I'm gonna
house,
just keep doing this to you. So if you just like throw out stuff, you got to follow it up.
I should go back to the housing example.
Okay, house example.
And you said it's depreciate over time, and you look at the cost of the house. Like you can tell about 10 years later, the house should be worth nothing because it's fully depreciated. But in reality, the house is not worth nothing because you can still sell it in the market.
Okay. How about the machine example?
The machine could be fully depreciated, but that doesn't mean it's stop working.
Right, but most likely you're gonna do what to the machine?
Replace it.
Exactly. So is in that sense, is depreciation a real cost? Yes, exactly. Go ahead, Joe. You want to see something else?
Well, isn't this kind of where like non-cash expenses get like a little buried on the income statement because it doesn't reflect like the true change of cash? So if you have like D&A on the income statement and the lower it like the operating income, it's not a true reflection of like what happened in that period. So in that way, it's kind of like maybe where the debate is coming.
Right. The idea is that it's a proxy for cash flow. This is the idea. And we can get into the nuances and stuff, but I don't know if it's really going to be of any help to you to get into the nuance.
Either way, adding it back.
You're adding it back because you're just trying to get a proxy for cash flow. How much does the business generate after it pays cost of goods sold and after it pays for the lights, after it pays for the rent, after it pays its wages, after it pays all this stuff? What is the general cash of the business? All right. So this is going to be your operating income and adding back your depreciation because you get a good general sense of what is cash flow of the business. Now, if you were a lender, all right, we're going to go back to the debt examples. And someone generates, there's two companies. One company generates, they generate the same EBITDA. They generate $100 million each. All right, $100 million of EBITDA. One company is capital intensive. They got to buy a lot of machines to generate that 100 million of EBITDA. Another company is not capital intensive, and they don't have any real intensity in their capital to buy assets that are really going to be depreciated. Which one would you pay more attention to their depreciation?
The one that uses the machine.
Exactly, because you know that they need those machines to generate what? Revenue, profit, earnings, right? They need that. So you're going to be a little bit more wary. And then how would you start to think about this? This is how you're going to think about it. 100 million here of EBITDA. D&A is 50. So how much of your EBITDA is baked in depreciation? Half. And how much of your EBITDA is just straight earnings? Half, right? So you got a 50-50 split here, right? So where's the risk here, right? So you're going to look in here and you say, okay, right? So this is your 50-50 split, right? Now let's say that it's like this instead, right? 10% of your EBITDA is D&A, right? 90% is your earnings, let's call it. Operating income, earnings, however you want to look at it. Would you think that this is more capital intensive or not? Well, it wouldn't be as much as the one that we just looked at before, right? Because the other one, the depreciation was what? 50-50, right? So they're depreciating assets. Now, these are general concepts. You get the nuance of things, it doesn't matter. The point is that how much of your cash flows are dependent on capital expenditures? How much of your cash flows are dependent on capital outflows, cash outflows? You got to pay to operate, right? So this is kind of how we're thinking about these things. So that is your EV to EBITDA. EBITDA is the most important number in finance. Simple. Everybody uses it. If you don't like it, too bad. It is the case. So you got to know it. You got to understand it. It doesn't matter what your opinion is, to be quite honest with you, to say it bluntly. People have to, I don't like EBITDA. It's not real. It doesn't matter. The whole industry uses EBITDA. All right. Every company is valued off of EBITDA, unless they have no EBITDA. But you're a banker. You work in valuation. You do private equity. You do consulting. Everybody wants to know what's EBITDA. Quality of earnings. If you're an accounting major and you want to get into finance, getting a job in quality of earnings is a great gig. Every EBITDA. That's their point. Private equity firms, investment bankers, everyone's hiring an accounting firm to quality of earnings. EBITDA is the number they want to know. What's the true EBITDA? So understand it and know it. Super important. Okay. We talked about EV to EBITDA, EV to revenue, and then there's also EV to EBIT. It's a lot less used, but all that's doing is doing what we were saying, taking out depreciation. Right? That's all that's doing. On a public market basis, you have equity multiples. Equity multiples are going to be price to earnings multiples, market cap to free cash flow, and PE to growth are kind of PEG ratios. I wouldn't really call that a valuation multiple, but it's just a sense of it. We can get into that stuff later. But this is kind of generally it. Now, why would a market cap or a price be to earnings? What's an earnings per share based on? How is an earnings per share calculated? What's the numerator in earnings per share? Net income's after what? So we paid COGS, we paid operating expenses. Then what's our next payment going to be? If we have debt, interest, and then we're going to pay taxes. So all that money left over is available to who? Shareholders. Equity holders, right? So when you buy a share of stock, you own Microsoft, you own Apple, you own Tesla. What are you buying a share of? Equity or debt? Equity. You're an equity holder. So you should really focus on your market cap, your multiples relative to your market cap. You could look at it because you're still an owner of the business. How overvalued is it on an enterprise value basis? So a lot of times you'll hear in the news, such and such company is, 60 times earnings per share. And I always look at what's the EBITDA multiple. Because a lot of times I find, and it makes me laugh, these are professionals on TV, you'll see like maybe 2 years out, the expectations of the company generate a ton of EBITDA. So the forward multiple on an EBITDA basis, looking out 2 years, is like 10 times. And you're just like, okay, yeah, it trades on an earnings basis. Yeah, it's high, but a couple of years out on our EBITDA basis, it's low. So the market's taking into that account. They're generating a lot of cash flow. They're going to generate cash flow. It's going to help sustain the business. So looking at it and say, oh, that's just crazy because of one input is kind of silly. You should look at it on a whole level, on all different kinds of angles, not just on one multiple. All right.